Hello everyone, greetings to all of you. Myself Dr. Niki8705. I'm a faculty from Management Studies Department from Changu Khana Thakur College of Arts, Commerce and Science, Autonomous, New Panvel. So in last lecture, we have discussed about corporate finance meaning and definition and all the introductory part. In today's lecture, we are going to see about the principles of corporate finance. Moving ahead, just to give you a recap, what do you mean by corporate finance? Just let us look into below. Corporate finance is a kind of a financial activity which related to how the corporations or the businesses can raise funds from the people to run their businesses. It majorly focuses on maximizing the shareholders' wealth by use of long-term financing facilities and short-term financing facilities with use of various strategies to implement them into the business to run their business more smoothly. Moving ahead, so these are the major points for the principles of a corporate finance. The corporate finance principles are financing principle, investment principle, principle of dividend payment, principle of shareholders value maximization, principle of risk and return, principle of profitability and liquidity optimization, principle of working capital requirement and working capital management, and internal control principle of the business. Moving ahead, who are doing this corporate finance job? The financial advisors, the financial planner, the chartered accountant are being appointed as a corporate finance manager to deal with the necessary monetary resources utilization, and they are taking the financial decision on behalf of a company for the smooth functioning of the organization. Looking ahead to the financing principle majorly focuses on how company are going to raise money from the people at a very low cost of an interest rate or low cost of a dividend, so that they can retain maximum amount of profit into their business. So they are also focuses on minimizing the cost of capital. Capital means the amount which is being raised in terms of a long term or short term funding, and the cost means the interest is to be paid on that debt. If company is raising the funds, so it is basically called as debt. So they are borrowing funds from the other financial property persons. So they are minimizing their risk by lowering the cost of debt or lowering the cost of finance. Second principle is investment principle. After taking the finance from the shareholders, stockholders, or the other person, or you can say the bank, they are utilizing that finance into the various modes. So they are somewhere investing their money into the business operation, or by purchasing the fixed assets, or by planning to expand their business. So this investment principle focuses on how the maximum amount of return they can get by utilizing the proper money to be invested at a very low cost, or you can say at a very minimum amount of a risk. So this is financing principle. Moving ahead, the third principle is dividend payment. Many of the shareholders or stockholders, equity shareholders or preference shareholders, they are investing their money into the company. Means company is actually raising finance from the public. So these money is being utilized by the company itself. So it is the responsibility of the corporation or the business persons or the business head to provide timely dividend distribution to the equity shareholder or to the stockholder according to their percentage of the investment. Next is working capital management. Working capital management is the major task or the major problem, or we can say the day-to-day requirement of the business organization, where they are utilizing the money on day-to-day basis. Means they have to deal with the money cash inflow or cash outflow on daily basis, and to run the smooth operation of the business, they are using the long-term financing as well as the short-term financing. Means whatever the money which being raised by the company, they are invested into their business operation, and through their investment they are running their working capital requirement or fulfilling their day-to-day needs of the separate business operation in the sense production operation, then planning operation, then management operation, or we can say in the manufacturing operation, then later on to the office operations and selling and distribution and logistic operation, supply chain operation. There are various n numbers of operation where these funds are properly utilized. Next, the principle of shareholders value wealth maximization. Shareholders or stockholders or its value maximization or its wealth maximization is one at the same. Here, the company feels that if we give privilege to the shareholder by increasing their value and giving their timely returns in the form of a dividend, they will definitely come again to provide finance into the company. So then they will feel very privileged. Due to this, they will definitely try and come again to invest into their company. So company major focus is to maximize the overall wealth of the organization by increasing the wealth of the shareholder. If one stock price is for rupees, for example 100 rupees a share, then if the value is being increased, like for example to 120 rupees of a share, then definitely the share of the company itself increases if they increases the value of the shareholder. Next principle is principle of return and risk. So there is a proper relationship between risk and return. It is being said that it is a direct relationship between the research, risk and return. So research is being applied where the investment is made. Risk is where they are investing the money, and return is where they have invested their money. So higher the risk, higher the return, lower the risk, lower the return. So basically more of the corporation target that they have to maximize the return by minimizing or optimal utilizing of their risk ventures. Next, we are going to study about the principle of profitability and liquidity optimization. Profitability means how much amount of a profit you are going to retain into the business in the form of a cash or cash equivalent, and how much amount of liquid cash is being available at the organization so that they can daily utilize that resources, monetary resources, in a fruitful way. So they have to use a proper planning for the proper utilization and channelization of the monetary resources into the different departments. Lastly, we'll discuss about the internal control principle. The internal control principle exists in the organization where it is a necessary job of the organization to focus more on management of funds and recording each and every cash and monetary transaction into their financial statement. You can say it can be the vertical income statement or a balance sheet, anything. It is a financial statement which represents their overall financial position. So it is necessary part of the financial corporate manager to deal with the management of the funds and to deal with the internal control system so that their overall functionality wouldn't hamper, and should be the proper utilization of funds is being utilized, and how much they are properly utilizing their fund into the purchasing of a new asset or selling of a new asset or purchasing of a new share or selling of a new shares. So these buying and selling of these financial assets can be in the form of a can be in the form of a tangible or can be in the form of an intangible asset. So this proper control is to be done by the financial manager so that they can return good amount of a profit into the business and to run it very smoothly. So these principles we have discussed in this lectures. So please study it, do hard work. Thank you so much.